Hey everyone, welcome back to Corporate Decoder. Today we're diving into Banzai International's recent 10K filing. Get ready for a roller coaster because this report is filled with more twists and turns than a poorly scripted reality show. We will uncover why Banzai keeps losing money, if this is sustainable, and where it might be heading. Let's get started. First off, a 10K is basically an annual report card that public companies in the US have to file with the SEC. It covers all aspects of the business, not just the financials, and gives an overview of the company performance over the last year. It can be a bit dry, but that's what the Corporate Decoder is here for. The report confirms that it's for the fiscal year ended December 31, 2024. This is their annual report, so they're laying it all out on the table for us to see. The company is called Banzai International, located in Bainbridge Island, Washington. Their Class A common stock trades on the Nasdaq under the ticker symbol BNZ. It is also worth mentioning that they also have public warrants with the ticker BNZ. They classify themselves as a smaller reporting company and an emerging growth company. This is important because it allows them to have lighter regulations than larger companies. The aggregate market value of their shares held by non-affiliates was only about $4.6 million as of June 30, 2024. That's not very much, and it indicates the limited investor interest. Alright, before diving into the real meat of the report, I will scroll to the table of contents so we can get a feel for the major discussion points. We have Item 1, Business, Item 1A, Risk Factors, Item 7, Management's Discussion and Analysis, and so on. It is worth pointing out that this report contains a huge number of what they call forward-looking statements. Always take these claims with a grain of salt. They are Banzai's own hopes and dreams of the future. And the report even mentions actual results of operations. May differ materially. Scroll itatum in basa atom 1, business stack scroll clave. Right off the bat, they describe themselves as a software, as a service as a company operating in the marketing technology industry. They sell tools to help companies market and sell with better impact. They claim to have over 90,000 global customers to date. They say that their company grows in 3 ways: by getting new customers, expanding their platform through acquisitions, and selling more solutions to existing customers. In other words, all the normal ways businesses grow. So let's see how well they're actually doing at it. They mentioned they're looking for profitable businesses to acquire, which, as we will see later, is something that Banzai desperately needs. They acquired 2 companies between early 2024 and early 2025, ClearDoc and Vidello, and have an agreement to acquire Acton. Their platform includes tools for webinars, video creation, and email newsletters. They point to the Winterberry report that says demand for marketing technology solutions is rising. So it does seem to be a growing industry, at least from their perspective. They compete within the B2B marketing technology value chain. Banzai engaged Winterberry Group to analyze their market opportunity. The total addressable market is projected to reach 39 ton and $42 billion by 2026. Their serviceable addressable market is 8.30 tast. In other words, their market is huge, which is a good thing because it gives them a lot of room to grow if they can get it. They list their product offerings as OpenReel, Create Studio, Vidello, Demio, Boost, Reach, and Curate. Their primary focus, they say, is on increasing mid-market and enterprise customers. They closed the OpenReel merger on December 18, 2024. OpenReel is a video creation and management solution. The merger consideration was $911,769,501 pre-funded warrants. They acquired Vidello Limited on January 31, 2025 for approximately $27 million in cash and 898,204 shares of Banzai Class A common stock. Vidello provides a suite of products for 3D video creation, royalty-free music, and video marketing. They entered into an agreement to acquire Acton Software on January 20, 2025, expected to close in Q2 2025. The Acton platform offers integrations with major CRM systems. Banzai utilizes a hybrid self-service and direct sales go-to-market approach. Their primary focus is on increasing mid-market and enterprise customers. They face a lot of competition, including Adobe, Vimeo, MailChimp, Marketo, and HubSpot. They believe their strengths are their recognizable brand, existing customers, and operational competency in customer success. Banzai relies on trademarks and trade secrets to protect their intellectual property. As of December 31, 2024, they had 28 full-time employees and 44 contractors. This is a shockingly low number of full-time employees for a public company, but that does not mean bad things in itself. They executed a 1-for-50 reverse stock split on September 19, 2024. A reverse stock split doesn't change the underlying value of the company, but it reduces the number of outstanding shares and increases the price per share. This is often done to maintain listing requirements on exchanges like Nasdaq. Scroll item 1A, risk factors. Item 1A. Risk factors, I'd scroll to time to dive into the risk factors. These are the potential problems that the company acknowledges could hurt their business. It is basically the management team's worst case scenario view of the future. One of the biggest red flags is that they have incurred significant operating losses in the past and may never achieve or maintain profitability. We saw that in the previous section when we were scrolling through their income statements. They say their losses will continue as they invest in growth, but there's no guarantee that those investments will pay off. Now this is serious. They mention there is substantial doubt about their ability to continue as a going concern. A going concern is accounting speak for if the business can survive in the near future. If they are not able to continue, that means a liquidation of assets is potentially incoming and there is likely that investors will lose all their investment. Their revenue growth depends on customers renewing and expanding their subscriptions. If they can't retain customers, their business will be harmed. They are also always looking for customers to upgrade and purchase additional products. The sales cycle can be lengthy and unpredictable. If they can't close sales in a timely manner, their operating results could vary significantly. They're susceptible to declines in demand for meetings and events due to economic downturns, natural disasters, and global pandemics. Any of these could affect their business and in turn affect their customers' business. They also acknowledge risks from cybersecurity breaches, which could create financial liabilities and damage their reputation. They acknowledge that they will need to seek more money, which may not be available to them. Future sales of common stock could depress their stock price. It's a classic supply and demand issue. They face the risk that Nasdaq may delist their securities, which would make it difficult for investors to trade their stock. Their dual-class common stock structure concentrates voting power with their CEO, Joseph Davey. He basically controls the company, which limits investors' ability to influence important decisions. They mention that they have identified material weaknesses in their internal control over financial reporting. This is a major red flag. The aggregate market value of the voting and non-voting common equity held by non-affiliates of the registrant based on the closing price of the shares of common stock on the last business day of the registrant's most recently completed second fiscal quarter was approximately 4,506,909 as of June 30, 2020, 2020 market, based on the last sales price reported for such date on the Nasdaq Stock Exchange LLC. That's super low, showing lack of trust and interest from the market. Scroller Titan 7, Manager Item 7. Management's discussion and analysis of financial condition and results of operations. 10 scroll could gives you and results of operations. Ren scroll calls, okay, let's get into the heart of the report, the management's analysis of their financial performance. This section often gives you the why behind the numbers. We will try to get a sense of the financial health of the company from this section. Their cash flow from operations was negative for both 2024 and 2023. It shows that they can't self-sustain and are reliant on outside capital. Their vision is to improve the value of customer interactions for companies. That is a fairly bold goal that most tech companies would love to achieve. Let's see if their strategy aligns with that goal. Their growth strategy involves cost-efficient customer acquisition, customer retention, product improvements, new product introductions, and acquisitions. Their primary focus is on increasing mid-market and enterprise customers. Progress towards this is reflected in our acquisition of OpenReel. They sell most of their products using a recurring subscription license model. Customers often purchase additional services to supplement their initial subscriptions. Trials, customers, and leads come from organic website visitors, affiliates, and paid ads. Their strengths are their recognizable brand, existing customers, and customer success. Here are some of the high-level numbers to take away in this report, NAF. Their revenue remains mostly unchanged, 4,528,000 versus 4,561,000 year-over-year. Kiawais and Vistas 4,000 versus 45 harnessed. The result is that gross profit also remained at approximately the same level. What's not looking great is general and administrative expenses increased by 28.2%. What this means is that the core operations are stagnant while the cost is increasing, making it an unsustainable business. It should be noted that they did acquire another company, so it's not entirely clear what caused that increase, organic growth or acquisitions. Their average customer value, or ACV, increased between 2023 and 2024, which is good. It means they managed to extract more money from existing customers. What is interesting to see is their high churn rate. It has an incredibly high percentage, 6-7 apps. They highlight that we may need to make significant investments in software development and equipment to improve our business. It is what you expect for a modern company, but also means more investment is needed in the future to keep it afloat. As it stands, for any potential investor, there are way too many risks and not many rewards in investing in this company. Their statement regarding their common stock class structures makes it even worse. Banzai's management recognizes that they are in a tough position because their forecast and overall financial condition may not be the best. The end goal is to build something greater than what they see today, so they still have hope. But hope is not a plan. Issuances of shares of common stock to YA2PN Ltd is in accordance with the Yorkville promissory notes, and they warn that those shares could cause a substantial dilution of our stockholders and may have a negative impact on the market price of our common stock, making shares even less valuable. Even they say it, they believe that their existing customers, their brands, cross-sold products, and their success will get them through this, which is great, but the numbers don't lie. Now, looking at these results more broadly, Banzai is an interesting company to try to analyze. They're in a large growing market, but their growth is clearly not keeping up with expenses. While they have some great qualities, their strategy of continuing to acquire more and more companies that then become a part of the company seems to be the wrong solution for their money problems. Unless they can start organically growing and cutting expenses, these roll-ups are just adding gasoline to the fire. Ultimately, there are just too many problems for this one to be attractive right now. Thanks for watching. If you enjoyed, please subscribe, like, and comment.